Across much of Africa, traditional banking infrastructure remains limited. In several countries, large portions of the population still operate outside formal financial systems. Bank branches are sparse in rural regions. Cross-border payments remain slow and expensive. Access to credit is constrained. By conventional measures, this is not an environment where financial innovation should accelerate. Yet over the past decade, Africa has produced some of the fastest-growing fintech markets in the world. Investment surged. Mobile-based financial services expanded rapidly. Digital payment adoption exceeded expectations. The question is not whether African fintech is growing. The question is why it is growing precisely where the system appears weakest. To understand the rise of fintech across Africa, we must first examine the structural gaps it emerged from. Across many sub-Saharan African economies, formal banking penetration remains significantly lower than in developed markets. Large segments of the population remain underbanked or excluded entirely from traditional institutions. Physical infrastructure is limited. Bank branches are concentrated in major urban centers, leaving rural populations dependent on cash or informal systems. Cross-border payments present another constraint. Remittance fees in parts of Africa remain among the highest globally, often reaching high single-digit or double-digit percentages. In contrast, domestic transfers in developed markets are frequently instant and low cost. Currency fragmentation adds further friction. Unlike unified monetary regions, such as the United States or the Eurozone, African businesses must navigate multiple currencies, exchange rate volatility, and regulatory variation. Under conventional economic logic, such fragmentation should slow innovation. Mature systems typically innovate through optimization, refining established networks. But Africa's financial landscape was not optimized. It was incomplete. Weak systems do not always prevent innovation. In some cases, they accelerate it. In developed markets, financial infrastructure evolved over decades. Card networks, legacy systems, and regulatory frameworks became deeply embedded. Innovation often focuses on efficiency, improving speed or reducing fees within mature structures. Across much of Africa, that mature structure never fully materialized. Instead of optimizing legacy systems, many countries moved directly toward mobile-first financial access. Smartphone adoption expanded rapidly, often outpacing physical bank expansion. For millions, their first interaction with formal finance occurred not through a branch, but through a mobile device. This dynamic is often described as leapfrogging. Rather than replicating decades of brick-and-mortar development, digital platforms bypassed intermediate stages of financial evolution. In markets long dominated by cash and limited credit systems, digital wallets offered more than convenience. They offered access, and access generates volume. As transaction volume increases, data accumulates. As data accumulates, new financial products emerge: credit scoring, micro-lending, insurance distribution. In contrast, developed markets operate within dense regulatory and competitive environments. Unentrenched incumbents create higher barriers to structural disruption. Africa's relative absence of legacy constraints enabled experimentation. Innovation did not grow despite structural gaps. It grew because of them. While these patterns are continental, Nigeria offers a useful lens. As Africa's largest economy by GDP and most populous nation, it represents both the scale and complexity of fintech expansion. Banking penetration remains uneven. Urban centers maintain relatively strong access, yet large segments of the population operate within informal or semi-formal systems. At the same time, Nigeria has become one of the continent's most active startup ecosystems. Over the past decade, a significant share of venture capital entering Africa has flowed into Nigerian fintech. This concentration is structural. A large young population with rising mobile adoption creates transaction density. Transaction density creates opportunity. But Nigeria also illustrates friction. Currency volatility introduces balance sheet risk. Regulatory shifts alter operating conditions. Cross-border expansion remains complex due to fragmented regional policies. These constraints do not eliminate growth. They shape it. Kenya demonstrates how early mobile money adoption can accelerate integration under different regulatory conditions. South Africa presents a more mature banking system, one where fintech competes within established institutions. The narrative is not uniform, it is structural. Nigeria simply magnifies the dynamics. African fintech expansion has been closely tied to global capital flows. Venture capital investment increased significantly during the low-interest rate environment of the late 2000s and early 2020s. Fintech captured the largest share of that funding, but capital is cyclical. When global liquidity contracts, emerging markets often experience sharper pullbacks. Risk appetite narrows. Valuations compress. Funding timelines extend. African fintech is not insulated. Its relative dependence on foreign venture capital increases sensitivity to global financial conditions. This creates structural tension. Growth has been driven by genuine demand, payments, remittances, digital credit, inclusion. But scale has often depended on external funding rather than sustained profitability. Developed markets benefit from deep domestic capital pools, institutional investors, and stable currency environments. Across much of Africa, domestic capital remains comparatively shallow. Currency volatility complicates long-term planning. This does not invalidate growth, it reframes it. The question shifts from expansion to sustainability. Can ecosystems transition from capital-driven growth to durable profitability? Can regulatory frameworks evolve alongside innovation? Can regional integration reduce fragmentation? These are structural questions. Their answers will determine whether this momentum represents a cycle or a transformation. Africa's fintech expansion is often framed as rapid growth, but growth is not the defining feature. Structural adaptation is. In mature economies, innovation refines existing systems. In many African markets, innovation compensates for incomplete infrastructure. When that distinction explains the acceleration of mobile-first finance, it explains the emergence of cross-border payment startups. It explains the immediate relevance of digital credit models. The same gaps that limited traditional banking created space for digital experimentation. Yet those gaps remain. Capital cycles are volatile. Regulatory fragmentation persists. Currency instability introduces risk. The trajectory will not be determined by enthusiasm. It will be determined by structural maturation, deeper domestic capital, greater regulatory coherence, and sustainable profitability. If those transitions occur, Africa's fintech sector will represent more than growth in emerging markets. It will represent a case study in how constraint can accelerate innovation. Not despite weakness, but because of it,